Ladies and gentlemen, good day and welcome to Hindustan Unilever Limited conference call for the results for quarter ended 31st December 2021. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. A. Ravishankar, Group Controller and Head of Investor Relations. Thank you, and over to you, sir.
Thank you, Faizan. Good evening, everyone, and welcome to the conference call of Hindustan Unilever Limited. We'll be covering this evening the results for the quarter and 9 months ended 31st December 2021. On the call with me from HUL is Mr. Sanjeev Mehta, Chairman and Managing Director, and Mr. Ritesh Tiwari, Chief Financial Officer, HUL. We hope that you're staying safe and healthy. We'll start the presentation with Sanjeev talking about our performance in this quarter, perspective on the operating environment, and our outlook for the near term. Ritesh will then share deeper insights into our performance for the quarter with category highlights. Before we get started, I would like to draw your attention to the safe harbor statement included in the presentation for good order's sake. With that, over to you, Sanjeev.
Yeah, with good health and a lot of happiness. Thanks a ton for joining us today. And I do hope not only you, but all your loved ones remain safe and well. Let me begin by talking about our performance in this quarter and then cover the market environment and the strategy to navigate through the challenges. We have delivered what we certainly believe a strong all-round performance in this quarter. It's a result of our strategic clarity, strength of our brands, operational excellence, and dynamic management of our business in an environment which has been changing rapidly. Our domestic consumer business grew 11%, significantly ahead of the market, resulting in handsome market share gains. More importantly, we've been able to build on our momentum and consistently step up our growth when seen from a 2-year lens. In December quarter 21, our 2-year sales CAGR was 9%, an increase from the 7% we had in September quarter and the 2% in June quarter 21. I will talk more about it in the subsequent slide. Moving on to profitability, our EBITDA margins of the quarter increased by 100 bps compared to December quarter 20, driven by prudent financial management led by increased focus on cost savings and incremental pricing based on the strength of our brands. Now, what we have done here is to unpeel the 2-year CAGR at a category level for a better appreciation of the quality of growth. It is a wonderful sight to see all parts of our portfolio contributing to a robust 2-year CAGR. Starting from the left side of the chart, you can see that our big categories like fabric wash, beverages, and skin cleansing have delivered a very strong double-digit 2-year CAGR. Household care and ice creams have done exceedingly well and also delivered a robust double-digit 2-year CAGR. So around 2/3 of our portfolio is growing double-digit CAGR. Another 30% of our portfolio, which includes categories like skincare, hair care, foods, and oral, have grown in high to mid-single digit. Rest 3% of our portfolio, which includes COVID-impacted categories of color cosmetics and water, had relatively soft performance over the 2-year horizon. I have said this earlier and cannot stress enough that in times of such high inflation and uncertain operating environment, it is extremely important to look at our business from the lens of competitive growth and whether we are retaining and growing our consumer franchise. In this regard, I'm extremely pleased to see that a consistent strong performance has translated into handsome market share gains. We have seen the highest year-on-year share gains in more than a decade. These gains are broad-based, and we have gained in all our divisions and both in urban and rural markets across all our regions. Share gains have come not only in the mass segment, but also in the premium and popular segments. In fact, a market share gain in the premium segment is at levels similar to our gains in the mass segment. The pandemic, while it has tested us, has made us stronger, more agile, and much more resilient as a business. We clearly are cementing our market leadership. The world has never had a clearer view of the environmental challenges that face all of us. The need for action has never been greater. We know we have a big role to play. We're a company of brands and people with a clear purpose to make sustainable living commonplace. One of the biggest challenges that all of us face is that of plastic waste. Plastic is a very versatile packaging medium that helps us get our products to consumers safely and efficiently. It's often the lowest carbon footprint option compared to other materials, yet far too much plastic ends up in our environment. To give you some numbers, India consumes an estimated 16.5 million tons of plastic annually. Around 70% of this ends up being discarded and remains in the environment. We need to minimize this plastic waste and create a waste-free future for the next generation. To achieve this, we have set ambitious targets which would all be attained by 2025. First, we'll help collect from the environment and process more plastic packaging waste than the plastic we use in the packaging of goods we sell. All our plastic packaging will be fully reusable, recyclable, or compostable. And lastly, we will reduce the amount of virgin plastic we use in our packaging through use of recycled materials and other means. We continue to make good progress. In calendar year 2021, we became plastic neutral, i.e., we have collected and processed more plastic packaging than the plastic we use in the goods we sell. Our program is not limited to a few cities, but we have a pan-India network spanning 160 locations. We are perhaps the only company of this size and scale to do this in every state and union territory of India. We have a framework called Less Plastic, Better Plastic, No Plastic, with which we evaluate a plastic footprint. Let me talk about a few examples. The first is an example of where we have reduced virgin plastic usage by replacing them with post-consumer recycled plastic, what we call as PCR. Bottles used for Vim dishwash, Surf Excel Matic, Surf Excel Easy Wash, Rin Matic, and Comfort are made with 50% PCR. Our Sunsilk and Tresemme shampoo bottles, Vaseline body lotion bottles also have recycled plastic incorporated. Last quarter, we spoke about the Smart Fill vending machine, which offers an innovative option to consumers to reuse plastic bottles by refilling their favorite home care liquids. We are already seeing encouraging signs from this pilot, and we intend to scale this up in future. We're also transitioning our soap wrappers and shampoo sachets to recyclable structures. Another example is Lakme, where we have created a refillable product, the Lakme Absolute Perfect Radiance Day Cream. The Combi pack consists of the main product and a refill pack. Consumers can order a refill pack once the product is consumed and thus save on plastic packaging. Ritesh will cover our in-quarter performance in more detail in his section. Let me now spend some time talking about the operating environment and our outlook. After two devastating waves of COVID, Indian economy is on the path to recovery. Several sectors of the economy are back to pre-pandemic levels of output. However, the recovery is still in the making, with different parts of the economy improving at varying pace. From an FMCG market lens, and here I'm talking about the FMCG categories in which HUL operates, we are seeing a moderation in the market growth. We had cautioned about rural growth in our September quarter earnings calls, and we do see the deceleration taking hold. With very high levels of inflation that consumers are witnessing, volumes in market have declined, and this decline is more accentuated in the rural markets and in those categories which have been impacted more by the commodity inflation. Commodity inflation continues to be a significant headwind for the industry. Palm oil remains at historic highs, while crude has rallied by more than 70% in the last year. Packaging feed stocks have also inflated significantly. Appearance of the Omicron variant, even before the economy has completely recovered from the shocks of the previous two waves, has made the environment more challenging. COVID cases are rising, and it is a reminder for all of us that the pandemic is not yet over. We should definitely not throw caution to the wind, and we should continue to take all the precautions. In these challenging circumstances, I'm confident that a clear and compelling strategy, together with our growth fundamentals for operational excellence, will hold us in good stead. We remain focused to deliver a 4G growth agenda, growth that is consistent, competitive, profitable, and responsible. As seasoned sailors, we will dynamically adjust our sails and navigate through the turbulent external environment. We are well positioned. The nearly 2 years of pandemic has made us a stronger, better business, which is much more resilient and responsive. And what makes us a formidable organization is the people who were and always will remain our number one priority. A wide and diversified portfolio, more than 50 trusted brands across 15 categories, places us uniquely. Our supply chain has become much more agile and responsive. All this positions us well to do with the uncertainty that we face. Let me now conclude with the outlook we have. In the near term, the operating environment remains challenging. Whilst the rising cases in COVID wave 3 are concerned, we expect limited impact due to a robust vaccination program and the health and safety measures taken by the authorities. FMCG market growth are moderating, and consumers are titrating volumes owing to the significant inflation that they are witnessing. Further, the inflationary conditions that I spoke about earlier are likely to persist in the near term. In fact, we expect to see sequentially more inflation in March quarter compared to December quarter. These commodities affect large parts of our business, and hence margins are likely to remain under pressure. Strength of our people and our brands, a clear strategy, and resilience of our business positions us well. We will continue to manage our business with agility, take all steps required to protect our business model, and expand our consumer franchise whilst maintaining our margins in our healthy range. We remain confident and are focused to deliver a 4G growth agenda. Growth, like that we say, is consistent, competitive, profitable, and responsible. With this, let me now hand over to Ritesh as he provides deeper insights into this quarter's performance. Ritesh, over to you.
Thank you, Sanjeev. Good evening, everyone. I hope that you and your loved ones are safe and keeping well in these difficult times. Let me talk you through our December quarter performance in more detail. We had a very strong delivery in December quarter. Domestic consumer business grew 11%. Reported turnover growth was 10%. The difference between the reported growth and domestic consumer growth is largely our export sales, which had declined off a high base where we had some one-off. This has been a strong, competitive, and broad-based growth. Underlying volume growth in the quarter was 2% and significantly ahead of market volume growth. Let me give you further insight into this. Almost 30% of our business comes from packs that operate at magic price points like rupee 1, 5, or rupee 10. In these packs, our preferred mode of taking pricing is by reducing grammage. As a result, even the same number of units sold leads to volume decline. This had a circa 2% impact on our volumes. Talking about our bottom line performance, EBITDA margin was healthy at 25.4%. In the backdrop of continued input cost inflation, I am pleased that we have dynamically managed the business to deliver margins in a healthy range as we had indicated earlier. Our focus on taking calibrated price increases using net revenue management principles, coupled with a laser-sharp focus on savings whilst investing behind our brands competitively, has helped us improve profitability. On a year-on-year basis, EBITDA margins improved 100 bps. Profit after tax, but before exceptional items, was up 17%. Our net profit at 2,243 crores increased 17% versus DQ20. Let me now give you a breakdown of the growth across the three divisions. Home care sustained its very strong double-digit growth momentum, growing at 23%. Beauty and personal care grew 7%, led by skin cleansing, skin care, and color cosmetics. Foods and refreshments delivered a steady performance, growing at 3% on the back of high teens growth in the base. We will click down to talk about performance within each of the divisions in subsequent slides. Talking about innovations, we continue with the momentum we had, and let me call out some of them. Simple, our clean beauty digital first brand, has launched a new range of no perfume serums, which are naturally derived and suitable for sensitive skin. Dove has launched Love and Care, a new range of hand and body moisturizers. Lakmé has expanded its cosmetic range with volume mascara, liquid concealer, and highlighters. Bru has launched a new product, Bru Beaten Coffee, on e-commerce channel. We have also launched a new toothpaste, Sensitive Mineral Active by Pepsodent, for sensitivity relief. This has been launched in Tamil Nadu in select channels. Moving on to the activations in this quarter, and let me talk about a few. Quality Walls activated ice cream gift packs and reached consumers offline as well as through digital channels to cheer during the festive season. Surf Excel had a new ad campaign on Matic liquids for semi-automatic washing machines. Clinic Plus created Vimy Films in South India, building on its proposition of long and strong hair. The new PVC of Dove Beauty Bathing Bar is talking about its moisturizing cream formula that provides moisturization like a cream while it washes away germs like a soap. Home Care had another strong quarter of double-digit growth enabled by robust performance in fabric wash and household care. Household care grew in high teens with a strong performance both in Vim dishwash and Domex surface cleaners. Fabric wash grew strong double-digit with all parts of the portfolio performing well. The business also grew volumes in high single-digit, reflecting the strength of our brand to price up in inflationary conditions. Liquids and fabric conditioners continued its exceptional momentum and grew handsomely. With the significant inflation persisting in crude and its derivatives, we have continued with our calibrated pricing actions in both fabric wash and household care. Moving on to beauty and personal care, BPC grew 7%, led by skin cleansing, skin care, and color cosmetics. Skin cleansing had a strong quarter with double-digit growth driven by pricing. The beauty and premium soaps portfolio, comprising of Lux, Dove, and Pears, grew in high teens. Hair care had a steady quarter enabled by strong performance in premium portfolio. During the quarter, we further strengthened our competitiveness with our market shares being at a 15-year high. Our brands, Clinic Plus, Dove, and Sunsilk were rated as a top 3 hair care brands in the country as per Kantar Brand Health Check Report. A calibrated approach towards price increase in skin cleansing and hair care has helped protect our business model even as vegetable oils continue to inflate at record levels. Together, skincare and color cosmetics delivered double-digit growth and are above pre-COVID levels. Winter portfolio performed well, growing on a very high base. You will recall that we had low winter sell-in during SQ20 due to muted trade sentiment at that point in time, and hence we were lapping a higher DQ in the base. Oral care had a soft quarter, lapping a high base comparator of DQ20. Let me now turn to foods and refreshment. F&R had another strong quarter in DQ21. The growth at 3% came on a very high base, resulting in a healthy 2-year CAGR of 11%. Tea continued its robust performance and grew competitively on a strong prior year comparator, delivering high teens 2-year CAGR. We further expanded our value and volume market shares in the quarter. Coffee continued to perform well and grew in high single digit. During the quarter, we launched Bru Beaten Coffee. We have spoken about extensive market development actions, including home-to-home sampling that we're doing in nutrition. This, along with A&P investments behind Horlicks and Boost, have helped us improve our market shares substantially and gain penetration. We had a soft quarter due to a high base, slowing market growth, and pockets of disruption in sales integration. Ambitious market development actions have been planned to enhance category relevance and grow the market. However, with wave 3, it is likely this might have to be scaled down in near term. Foods grew on a strong base led by jams and ketchup. We are very pleased to see that our recent foods innovation, Kisan Peanut Butter and Hellmann's Mayonnaise, are gaining traction with consumers. Ice creams had a very strong quarter, delivering 2-year CAGR in high teens. This has come on the back of some very impactful innovations like the Quality Walls Trixica and Cadbury Crackle Tub, and effective activation around festive season. Let me now give you a snapshot of our performance from a portfolio lens. As you can see, all parts of the portfolio have performed strongly. Health, hygiene and nutrition, which is 85% of the business, continued to grow at a very healthy pace with a double-digit 2-year CAGR. With the resumption in mobility in the quarter, discretionary and out-of-home categories have rebounded strongly and are above pre-pandemic levels. As you heard from Sanjeev, inflationary headwinds sustained in this quarter. Palm oil and its derivatives, which are used in our skin cleansing and hair categories, have seen prices climbing further. Our expectation is for global prices to remain supported in the near term. Crude and its derivatives are key inputs for our laundry and household care category. As you know, Brent crude has been firm at 80+ levels and inflation of over 70% versus same period last year. Packaging materials, both plastics and paper and board, continue to be at very high levels. We have spoken earlier about freight inflation and impact from supply chain disruptions which have impacted certain raw materials. All of these put together impact 2/3 of our portfolio. After factoring in all buying efficiencies, which we deliver through our procurement capabilities, our material cost per ton has still inflated more than 30% compared to the levels we had in financial year 20. This was also up sequentially compared to SQ21. In the face of such unprecedented and widespread inflation, our dynamic financial management has held us in good stead. If you look at our EBITDA margins across the past 4-5 quarters, we have kept it in a very healthy range. There are a few key elements in our model to manage this. The first is keeping a hawk-eyed scrutiny on the price versus cost equation. We continue to step up pricing through calibrated actions using net revenue management, or the science of pricing as we call it. This is also reflective of the strength of our brands. We drive savings harder across all lines of the P&L with an intent to reduce costs that don't benefit our consumers and customers. Through these actions and with an improving mix, we have been able to optimize our COGS percentage and bring it back to below 50%. We have also maintained that advertising and promotion is a much needed investment for the long-term health of our brands. We continue to ensure competitive levels of A&P is put behind our brands with our share of voice ahead of our share of market. I would also want to make it clear that this does not mean that we put in same levels of A&P spend every quarter. But what we're doing is to dynamically manage and optimize the spend to ensure competitive levels of investment whilst maximizing return. In times of such high inflation, it is imperative to look at growth from the lens of competitiveness. Here we're doing a fantastic job, and Sanjeev has already spoken in much detail about the progress we have made on expanding our competitiveness. The key point I want to add is that we have got this balance very nicely stitched up, where we have expanded our competitiveness while ensuring margins remain healthy. Looking forward, I don't see an immediate respite from commodity headwinds. In fact, we are witnessing sequentially more inflation in NQ compared to DQ. Hence, we will continue to dynamically manage the business on the same principles that I spoke of. Now, from a segment lens, all 3 divisions have performed well. Our operating margins in all 3 divisions are very healthy, and we have stepped up gross margin sequentially in all 3 segments. In summary, our performance has been strong both on top line and bottom line. I've already covered most of the lines in detail. Let me pick up a couple of more things to elaborate. The first is on employee expenses in the quarter, where you see a 30 BPS year-on-year adverse impact. We have trued up our defined benefit pension liabilities. This is actual estimates due to a change in pension rules. We also have impact of true up and true down of variable pay. This is normally done in December quarter based on full calendar year performance and has therefore one-off impact in both base and current quarter. The second is on our effective tax rate. Our ETR for the quarter was 26%, which is at similar level as previous quarter. Including the prior period adjustment we received in June quarter 21, we expect our financial year ETR to be around 25%. This slide gives you a quick snapshot of the three-quarter performance of financial year 22. Our reported turnover grew 11% to 37,146 crores, with a broad-based growth across all three divisions. EBITDA margins at 25% remained very healthy. Net profit was at 6,491 crores. PAT and EPS grew 12% year-on-year. I also wanted to take this opportunity to update you regarding the approvals we have received under the production-linked incentive schemes of the Government of India. We have received this approval in two segments: ready to cook, ready to eat, and processed fruits and vegetables. For us, these include categories like ice cream, jams, ketchups, soups, mayo, etc. The scheme, which is for 6 years, is subject to meeting certain committed investments and defined incremental sales threshold. We will be reporting this in other operating income. There is no impact in this quarter. I would also like to be clear that we intend to use these incentives to further grow these categories at a clip pace by investing in our business and in creating capabilities. Now let me summarize the key messages from what we have presented in last 30 odd minutes. We had a solid quarter with double-digit growth and significantly ahead of the market. You have seen that our 2-year growths are also very robust with sequential step up versus earlier quarters. Our dynamic financial management has enabled us to deliver EBITDA margins in a very healthy range, whilst we are continuing to invest towards the long-term health of our brands. We have further strengthened our leadership position and our market share gains are highest in the decade. Looking forward, the operating conditions remain challenging in the near term, and there is further sequential commodity inflation in March quarter 22. The strength of our brand, our very clear strategy, and our execution prowess gives confidence that we will be able to manage our business with agility, delivering competitive growth and maintain margins in a healthy range. With this, we complete our prepared remarks, and let me now hand over to Ravi to commence our Q&A session.
Thank you, Sanjeev. Thank you, Ritesh. With this, we will now move on to the Q&A section. In addition to the audio, as always, our participants have an option to pose the questions through the web option on your screen. We will take these questions just before we end. With that, I'll hand over the call back to Faizan to manage the next session for us. Over to you, Faizan.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Avi Mehta from Macquarie. Please go ahead.
Hi team, I just had 2 questions. You have talked extensively about rising input cost inflation. Could you share if you've taken any further price hikes which would flow through in MQ and offset this in sequential rise?
Yeah. Hi Avi, Sanjeev here. Yeah, if we look at it the way we have been playing the game, whenever there is a commodity price inflation, the kind of which we have been seeing in the last few quarters, we always look at first optimizing all our lines, and seeing that where can we drive further scale benefit, further productivity benefits, And over the last couple of years, we've got a good rhythm of cost saving. And the cost savings have been to the tune of 7-8% of our turnover. And now at times it has also reached 10% of turnover. That's the first thing we do. The second is we try to protect the price point back as far as possible. And then we look at it from a WIMI lens. And we try to see that where there is much more flexibility for us to take a price increase. Our primary objective under these circumstances are twofold. One is to ensure that we continue to gain market shares, both volume and value. And the second is we protect our business model so that our margins remain within a certain range. And if the reality is we are seeing that in the March quarter also, there will be commodity price further increase. So we will keep doing calibrated price increase based on the principles that I have articulated.
Okay. Sanjeev, I'm clear on this part. What I was trying to appreciate or understand, would it be that a lot of the load of offsetting these pressures would fall on playing the lines of the P&L, or would we have some pricing buffer still in our? That is what I was trying to kind of appreciate or understand.
Yeah, first is if I look at the brand power, just to give you a perspective, our brand power has been absolutely sterling. Our brands have never been stronger. And the brand power, which the other bit, very important bit, is product superiority. In half our portfolio, we have got very clear product superiority. And that gives you even much more strength to take the kind of decisions we have to take when it comes to pricing. So we are cognizant about India, about the population we have, and the brands, which kind of population it caters to. And where there is flexibility to take price increase, we don't hesitate, we lead the price increase.
Clear. Okay, perfect. Just the second bit, Sanjeev, is just wanted to kind of get your thoughts on when do you expect to start changing the playbook from the competitive kind of focus on growth to more volume growth? Would it be fair to expect this in the second half of FY23?
There are a couple of questions here, Ravi. That's a good question. One is, of course, when do the commodity prices start tapering? If we have to, without doing crystal ball gazing, but looking at some of the fundamentals, I think the factors which have gone into this kind of price increase are more supply-led than demand-led. And the second important bit is in certain areas, certainly like crude oil and all, that in recent times there has not been as much capital investment as there ought to be. Now, whenever the demand surges, the capital comes back and people try to ramp up the capacities, etc. And these are all cyclical products. Our feel is that in the second half of the calendar year, we should start seeing first tapering, first the flattening of the curve, then the tapering of the curve. And the other important variable is the money in the hands of consumers. Yeah, we hope that the government continues with the relief that they've given to the stressed and rural areas, and if they can, extend it to urban areas. And outlays like Manrega and all should not only be continued into 22, but perhaps be even the outlay should go up. And those are the two factors which will start driving more money in the hands of more people, as we often say, and the softening of the commodity price inflation. That is where we will start making a switch back to volume-led profitable growth. But under these circumstances, market shares and protecting the business model remains the two most important imperatives.
Perfectly clear, Sanjeev. Just a bookkeeping, if I may, just on the GSK or the nutrition business, could you give us a sense on what is the level of sales integration, and is that more or less done, and hence that impact?
A large portion of the integration has been done. I would say, Ritesh, am I right if the figure is about 85%?
Yes, Sanjeev, it's gone about 90.
About 90, yeah. So that integration is done. The good bit is that we've started to see now penetration and market share gains come back into HFD. And now it is all about market development. Market development with the right kind of environment, and we should start to see good growth coming back. But the good bit is penetration and market shares are up.
Perfectly. Perfect. Thanks a lot, Sanjeev, and wish you luck for each quarter.
Thank you, Avi. Take care.
Thank you. The next question is from the line of Abneesh Roy from Edelweiss. Please go ahead.
Yeah,
Hey,
thanks.
Abneesh, how come you did not open the bag today?
There was a clash with one more company.
I see. Okay.
So, Sanjeev, firstly, congrats on good set of numbers. My first question is on market share. So, decadal high market share expansion. Now, decadal high inflation is also there. And this is always there in FMCG. Whenever sharp inflation happens, the leader gains market share. So, my question is the sharpest gain in products where, say, raw material was the most inflationary? For example, is it in soaps and tea? And second follow-up is in tea, after sharp inflation, sharp deflation is happening, and what we are picking up at the lower end, smaller players, regional players are getting extremely aggressive.
Yeah.
So how are you playing that in the lower end?
So that's a good question. Yeah. First is, when we are talking about market share gains, and this is the year-on-year gains that we are talking about, this is the highest we have seen in more than a decade, not even a decade, more than a decade. Yeah. And this is across a portfolio, across the three divisions, across mass, popular, and premium. And that gives us comfort that these are not something which is just because it is, more organized players are there. So that's the reason we are getting better. There is more formalization of the economy. That's the reason we are getting. No, even at the mass end, we are getting market shares. I think a lot of the market shares we must understand is based on the strength of our brands, the brand power, what we call as. And like I was explaining to Avi a while back, it is also backed by a huge amount of product superiority. We have been investing to gain product superiority. And all this are, when the times are tough, the consumers veer towards trusted brands. And you cannot afford a brand which doesn't given you or live up to the promise that is made to the consumers. So from that perspective, again, it is something that we remain very proud of. And once we gain market shares, we are very clear that we will retain them and not be losing them again.
Sure. And tea, any clarification on the lower end?
Lower end, that's what I'm saying. Even at the mass end, we are gaining market share.
Right. Second follow-up there is essentially in hair care, your market share is at a 15-year high and very sharp gain versus the number 2 player on a YOY basis. And your all the top 3 brands are yours only as per Kantar. So any learnings from hair care which can be taken to other categories, or is it unique to this category where you have a right to?
Thank you, Abneesh, for this question. It is not related just to hair care. You look at hair care, you look at laundry, fabric cleaning. Yeah, it's the biggest category. And what a fabulous performance it has been over years. And we have been galloping our market shares and strengthening our brands across the pyramid. Look at tea. We not only took leadership on value, then we took a leadership of volume, and now we keep increasing our lead. So it is across a large part of our portfolio that we have strengthened our market position over the last few years.
And Sanjeev, these market shares, are they factoring in the impact of the B2C startups? Why I'm asking this is, you are servicing 15% of your demand digitally, 7 to 8% coming from e-commerce. But when I see, for example, Mamaearth, Wow, Sugar Cosmetics, everyone is claiming anywhere from, say, 100 crores to 700 crores exit run rate kind of numbers. So where is that coming from? Because in retail, we saw huge disruption by startups.
Yeah.
So
come to think of it, if you look at the total industry, FMCG industry, yeah, direct to consumers is still a very small part of the total mix. Yeah, the biggest part is still non-online, which is the biggest part of the deal. Now, you must understand that we are a 50,000 crore business. And if we grow at 10%, on a per annum basis, we are adding 5,000 crores. You always look at 100 crore, 200 crore, 300 crore. In a year, we are adding 5,000 crore.
But any learnings or any disruption can happen here because these are PE funded, so they can take losses also.
See, the way it is, we anticipate disruption. But let me give you my perspective of things. First is, across the world, the big brands are growing and growing fast. Yeah? It is not that the world has veered away from the big brands. The second is, yes, there are e-commerce players, digital-first brands who have done a great job. And that is the reason why also we have set up, things like Premium Business Unit to compete in that area. And, Premium Business Unit is giving us absolutely brilliant traction. We have great talent over there. We are building capabilities. And the other is, you would recall that we started investing in e-commerce capabilities much ahead before it reached the point of inflection.
Right. Last question to the...
I think we are ready for it.
Sure. Last question on the 2% impact on volume because of grammage cut. Consumer behavior-wise, when say the product is over at home, in the past, doesn't he increase the frequency of purchase when, for example, now diesel prices have been cut, right? So now disposable income will increase. So will you see recovery there?
Yeah, absolutely. What we do, Abneesh, when it comes to price point packs, is when there is hyperinflation, we titrate the volumes in those packs because we try to protect the price point as far as possible. And when the commodity prices go down, we restore the fill. We improve the grammage. Yeah, and we have to understand a bit about the dynamics of the India, where average income is $2,000. But if you look at the bottom 50% of the population has only 10-15% of the total consumption. So these are people who would be very conscious about the money outlay, and they would be titrating the volume to protect their wallet, because the wallet is so small and so limited. Whereas, why we are saying also at the same breath that premiumization continues to happen, because there are many consumers in India, mainly consumers of premium products, for whom FMCG is a small share of the wallet. So even when there is a price increase, it does not impact the volume to that extent. So the growth keeps happening over there.
Sure, that's very helpful, Sanjay. Thanks a lot and all the best. Thanks.
Thank you.
Thank you. The next question is from the line of Arnab Mitra from Credit Suisse. Please go ahead.
Hi, Arnab.
Hi, and thanks for the opportunity, Sanjeev. My first question was on the nutrition business. So now that the GTM integration is complete and you've also, done the price point intervention, the growth still looks a little anemic here compared to your overall growth. So do you see a lot more interventions required from your side to get this growth rate above, let's say, actual average growth rate? Or would you think in the next 1 year at some stage, all the interventions we've already done would start getting you into the double-digit kind of ambition that you have?
Yeah. That's a good question, Arnab. And you're absolutely right. Our ambition remains completely unchanged. And I think in the last 20-odd months, we have done very good interventions. Yeah, first is the integration that happened. Then it was the CD integration. Perhaps had there been no COVID, the CD integration could have happened about 6-9 months earlier than what it happened. Yeah. The third is, if you look at the fundamentals of our marketing, we have strengthened our brands. The communication has changed. We have increased the intensity of our communication. Our innovations have been very good, and the Plus range is getting good traction. Now, there is also an environment under which we are operating. Our schools have been opening intermittently. One of the big consumers of some of our variants of Horlicks are the school kids. And when kids don't go to school, there is very clear evidence we have that the consumption of Horlicks doesn't go as much as it is when the kids go to school. And while they are home, because the mothers have other options rather than just giving Horlicks. For us, the most critical bit, Arnab, is going to be market development. And in market development, we have the prowess. We know that we have the expertise and we know how to develop. It may take a few quarters here and there, but I'm very confident that we'll get the rhythm. And the good bit, Arnab, is that the penetration is back and the market shares are back.
Okay. So in terms of just a follow-up on this, in terms of market development, is it like a long-term haul or it's something which you would expect would start giving results over the next 12 to 18 months also?
Well, absolutely. You look at the categories that we have been focusing on, conditioners, for instance, or the premium skin, for instance, or the liquids. You should, just look at the way in which our liquid business has been growing in home care, for instance. This is all based on the market development efforts that we have, or the way we grew green tea. Green tea, we were a very small player a few years back till we started the market development activities. Not have we grown, but we have become clearly number one leaders with Lipton. So market development, we know it, and it is not a one-year phenomenon. Market development in HF, we have been growing categories where the penetration is near universal. And HFD is a category where the penetration is in mid-20s. So the runway is there, and market development, not just me. My successor will also keep talking about market development in HFD, because this is going to continue for a long period of time, and that is how we are going to build this category into a real big category. At the end of the day, in a country like India, nutrition is a big issue. Malnutrition is a big issue. Many people do not have the micronutrients they need. Vitamins is the issue. So this category is going to play a big part. And the high science range is another thing where we are going to play in a very big way.
No, thanks for that. And my next question was just related to the previous answer you gave on e-commerce. So my point is that these turnovers of these B2C brands are quite small compared to HUL turnover, but they are all in those categories which you consider categories of the future. And a lot of the incremental turnover in those categories is going to come through the Nykaa's and the other e-com platforms. So is it at all a concern that, is your premium range going in line with, let's say, the 40% GMV growth that a Nykaa would have? Or would you need to have a lot more interventions to have your fair share in that incremental pie?
First is, I would be wrong in saying that, at the premium end or at the masstige end, we have stitched all our portfolio. No. We have work to be done, and that is the reason why we set up this premium business unit. And in the last 1 year since it's been in operation, we are seeing absolutely good traction. But let me give you from another lens. We talk about market development, and these are all mainly in the premium end of the portfolio. And this is about 20% of our portfolio. And this is a portfolio which is growing at an average of 1.5 to 1.7x the normal growth rate of the company. So you will, even 20% of our portfolio of 50,000 crores is a pretty large portfolio. And there we are getting good clipped growth rates.
Right.
And must also understand that a large part of the growth that is coming to many of the e-commerce players are not consumer growth. They are channel shift growth.
Okay, got it. No, that's helpful perspective. Thanks so much. That's it from my side. All the best.
Thank you, Arnab.
Thank you. The next question is from the line of Alok from Ambit Capital. Please go ahead.
Yeah, hello sir. Thank you for giving this opportunity. I had two questions. So firstly, in terms of, course, on the distribution side, while a lot has been reported, just wanted to hear your views on why this sort of general conflict, and what is it that the companies like like yours will gain by relying more on this channel? And any internal thresholds that you would have as a company in your mind to not have an exposure to a single channel intermediary beyond a particular percentage? And what will be the terms of trade, if you can elaborate a bit more on this? That's my first question.
Look, first is, from our lens, it was much ado about nothing. There was a lot of news items, and this was not a distributor standoff as it has been made out to be. We have got over 3,000 distributors, and we have a very long-standing relationship with them. And they have, most of our distributors in the state of Maharashtra, which was alluded to in the press, they overwhelmingly conveyed to us that they would continue to meet the needs of our shoppers and consumers in an uninterrupted manner. You have to understand that many of our distributors are third-generation distributors. Yeah, and for us, we treat them as partners, integral to the company. And any issues that we have with them, we discuss it and address it bilaterally. For us, it is very important to ensure that our distributors are strengthened, and importantly, the return on investment, which we have committed to them, we ensure that they earn, because that's how they remain in the business. Now, there is this federation of distributors, which where all the news came, the noise came in the press. Now, our representatives, they wanted to engage with us, and we were very happy to engage with them. And when we engage with them, we have been talking about things which are macro issues. Yeah, these are not the bilateral issues. Issues about technology, issues about manpower, issues about credit in the market. Those are the things which we talked with the distributors. And I think it's good that the distributors have an association, because they also need to bring very clearly aligned interests together. But as far as our distributors are concerned, this is all about bilateral issues which we keep sorting. Now, let me give you one example why we remain so committed to our distributor. Take Shikhar, for instance. We have got now over 7 lakh retailers who have adopted Shikhar. And every month the sales from Shikhar keeps going up. Now, this sales is not serviced directly by us. This sales is serviced by the distributors. So we have been investing in technology to help our distributors. We are not circumventing the distributor. And that is the reason why the distributors were very clear in telling us they are completely with us. So if you were to ask me that, is this a big issue for us? Certainly not, the way we have been looking after our interests and protecting the interests of our distributors. And to our distributors, the game is not about margin, the game is about return on investment. And in return on investment, there is a numerator and a denominator. You could be playing on both to ensure they get a fair return.
Correct, fair. And just a follow-up to that, because it is somewhere given that the share is only going to go up. So would it be kind of to tell us how the terms of trade would be different? Because you see, what will happen is that today that distributor share could be X, but maybe potentially a few years down the line that could be 0.9x, considering the way how market is playing out. So for us to factor in a long-term scenario for your company.
Yeah, let me give you a local perspective. This is very similar to when cash and carry came into India about a decade back. Yeah, because they also service the retailers. And we were very clear that cash and carry is going to supplement our existing distribution setup. It is not about either or. For us, it is and. And there are certain SKUs, because, at the end of the day, we have got 10 million outlets. We would be having the largest coverage of directly covered outlets, but still there is a large number of outlets which are serviced through wholesale. Now, there could be better ways of servicing them and serving them better. And that's the kind of role which cash and carry played. But we ensured that, importantly, the business runs in a manner that we protect the paramountcy of the general trade and the distribution business. They are still our largest channel, and even in 10 years from now, they would still remain the dominant channel. And that's the reason we are investing in technology for them.
Right. Yes. But, lastly on terms of trade, if at all, any comment that you can make?
Again, I'll tell you again, Alok, very similar to the modern trade. When modern trade came in, people were alluding to the same things. Now, we must understand that the kind of shoppers go there are different than what would go to a general trade. That also implies that the assortment we sell over there are different than what we sell over there. So from our perspective, we will always endeavor to ensure that there is a right return on investment. There was a time when all the salesmen were directly on the payroll of the distributors. Now to ensure that we get better salesmen over there, we had another agency on whose payroll the salesmen moved. Now that does not mean that we have alienated the distributor. That cost has come out from the distributor, but we are still seeing that the return on investment remains constant. So there will be areas where we will bring in productivity and efficiency, and there will be areas where we will invest more to ensure they get the fair investment.
Fairly clear. Thank you very much. My second question, Sanjeev, while of course, we previously touched upon D2C and you very clearly talking about this premium division that you have set up. Are we looking at more disruptive innovations and, because some of the innovations that, we have been discussing, to me, to me seems more an adjacency rather than any disruptive innovations which can counter D2C. So what can we expect specifically in which category? Would it be largely DPC or your views on the same?
See, now when you look at innovations and when you look at it from a perspective of disruptive innovations could be in any way. It could be in products. It could be in business model. And whether it is route to market or whether it is any other way, or it could be disruptive in processes which give you massive savings. Now, as a company which is high on innovation, we look at it from all lenses. Now, you may find sometime that certain trends are captured by some company before us. So be it. Not all the trends would be captured first, always by us. But look at the way, the way we have grown the liquids business in home care. It's been absolutely fabulous. Look at the way we are now growing our hair conditioner business. It's absolutely been fabulous. Or look at the way we have over the years grown the color cosmetic business. So we do innovate. Sometimes we are not first, but so be it. We could come second and still be better.
Got it. Lastly, if I can just squeeze in one more, the whole concern on the rural, while, you were first to call out in the previous quarter, somewhere, that has now started to get reported very clearly and, but there are talks on construction pickup, infra pickup. So where in this whole curve of rural distress or softening of rural markets where you think we are in, and by when potentially, you think we could be talking about more of a revival from the rural market? That's it. Thank you.
Yeah. Thank you for that question. What also has happened that there are certain sectors during the COVID period have been impacted severely. If you look at restaurants, we do our Unilever Food Solution Services restaurants. About 30% of the restaurants across the country have shut down. If you look at tourism, hotel industry, that has been impacted severely. A lot of people have gone back to their hometowns in rural areas. And that is the reason why the utilization of Manrega is higher than the pre-COVID level. And the benefit, and what I believe, Alok, that during the intervening period before the private capital investment kickstarts, which in turn would depend on private consumption moving at a much higher rate, government will have to play a big part. And that is the reason we believe that in this budget, the government of India should not be radically bringing down the fiscal deficit. They will have to play that big part, and investments play a big part because it has a multiplier effect over many industries, creates jobs, and it results then in the growth coming back. So they would have to play a part. But right now is, I think the government should also increase the outlay on Manrega. It is touched about close to 1 lakh crores. Perhaps it could be higher getting into the new year. And also the benefits that they provided to the rural stressed and rural poor perhaps should continue for more time till the economy completely stabilizes. Because think of it, Alok, at the end of this fiscal year, the economy would be of the same size as 2019, 2 years back. So we have virtually, as a country, lost the normative growth rate for 2 years. So it's a recovery underway. Recovery has not yet fully happened.
Got it. Absolutely clear. And I just hope that the state governments also bulk up their spending.
Yes, absolutely.
Yeah, that's it. Thank you from my side, and good luck for the ensuing quarters.
Thank you. The next question is from the line of Vivek Maheshwari from Jefferies. Please go ahead.
Hi, good evening, Sanjeev and team.
Hi, Vivek.
Hi. A few questions, just continuing with the earlier one. So one of the slides in your presentation where you have given Nielsen market growth in volume terms, of course, rural is negative. During this period, is it that urban is also not growing to actually being negative, Sanjeev?
Yeah, urban volume growth is about flat if we look at the last 3 months. And again, urban is not a homogeneous entity because there are also urban low-end consumers, and there are the high-end consumers which are much more resilient from a pricing perspective. But the impact on rural is much more than compared to the urban volume growth numbers.
Got it. And while you have explained, right at the beginning as well as to the previous participant, but as I heard you, it looks like that, rural may still take time to recover. Will that be a fair conclusion?
Rural in our country depends on many factors. Yeah. One is, of course, the harvest has to be good, but thankfully the sowing has been good. So I see no reason why the harvest should not be good. The second is also the role that is played by MSPs, etc. Because over the years, the wage rate inflation has been pretty low in rural areas. And the third is, one aspect we should not forget that in rural, while the volume growths are negative, the value growths are still positive. Yeah, it's not reached a stage. And if you look at the 2-year CAGR basis, then the value growth in rural would be looking even a bit better, but albeit 19 was a soft year for rural areas. So a lot of dynamics are at play, but the consumption is not something which changes overnight. If you were to ask me, Vivek, will February month result in the consumption changing? It doesn't happen. It turns around, it slows down also over a period of months, and it picks up also over a month. I think in many ways, the volume growth would be linked to the softening of the commodity prices. Yeah. And the other variable is money in the hands of rural consumers. So these are the two things which will play when you start seeing the volume growth come back. And that's the reason during this period, our focus is on ensuring that we keep growing our market shares and keep protecting our business model. Now, this is unprecedented. We have not seen this kind of inflation in multiple commodities all coming together. So that's the deck of hands we have got. And the important bit is how do we adapt to this deck of hands and still play a game and come out as winners.
Sure. Got it. And, Sanjeev, you made a comment that, March quarter inflation on a sequential basis, you are still, or it's going to be still higher. But if I, let's say marry this with the price hikes that you are taking, does that still mean that, margins on a sequential basis maybe, let's say, flattish to plus minus here and there? Or you think that, because the portfolio is, continuing to see price hike, and I'm guessing with this kind of inflation deck, you will have to still take up prices. So from a margin standpoint, it should still be, let's say, stable, give or take?
Let me bring in my very capable CFO to give you a perspective.
No, thanks for the question. See, what we have called out are very clearly two elements. In times like this, when inflation is very firm, and as you mentioned that in March quarter 22, we do expect sequentially inflation further. That happened in December quarter, it happened in September quarter. Our decision will be very similar and our action will be very similar to what we articulated, which are two. Number one priority is to ensure that we're able to grow our consumer franchise, and hence competitiveness and market share remains first port of call in terms of KPI that we want to deliver. The second area is, of course, to protect the business model, which means we want to ensure that as inflation further picks up, we want to maintain our EBITDA margins in a healthy range. You've seen last 4 or 5 quarters, we've seen inflation of a very high order. And we did that. Every time we had very consistent narrative that when inflation happens, we will drive very hard savings, we will maintain competitiveness, and we will maintain our margins in a healthy EBITDA range. This is exactly what we want to do, is to gain consumer franchise and keep protecting the business model.
Got it. And one related question, I was just reading recently, just like, in the last couple of days, Indonesia is talking about, in some ways tightening exports of palm. Do you have any views on, its implication either from a pricing standpoint or supply standpoint for Hindustan Unilever?
See, overall palm, as you know, you're right, Indonesia is the largest market where palm is produced and sold, along with Malaysia. We have not seen as yet any amount of implications on supplies of palm which comes in. And of course, a lot of palm comes in the country. As you know, we use PFAD, which is a product which comes out in the processing and refining of the oil which happens. And there's enough amount of supply of PFAD in the country. So we don't see, as we speak now, we don't see any impact of supply issues with palm. Now, of course, these commodities are cyclical in nature. We do expect it to further firm up in March quarter, and the prices will be supported. But as we get into season, and depending upon how the production takes place, and you also know what happened at the peak of COVID, when there were labor issues, availability of labor in palm plantations in Indonesia, production took a beating. It was not the agriculture output which was an issue, but labor was an issue. We do hope that with world coming out much better, with far better vaccination and infection being not as severe as we've seen in earlier waves, we should expect to see very good labor availability, and hence, hopefully the season is good, we should see good palm production. So now those variables we will only know as we get into season. But as we speak now, we don't see any stress in terms of volume availability. But yes, prices are supported in short term, and hence we do see prices will remain supported in March quarter. Now, of course, the second variable is crude for us, which impacts for us home care business. It impacts plastics, and as you've seen at 80 plus levels, crude has remained supported. That brings in a dynamics of price inflation across home care and across personal care as well, beauty and personal care, because of the impact on plastics. Now, the strategy will remain exactly as I mentioned earlier, which is to keep balancing competitiveness and keep protecting the business model. And we will do that consistently.
Vivek, I find this a bit counterintuitive, Indonesia curtailing supplies, because look at it from this lens, that Indonesia, it's not that they're going through a great economic cycle. They're going through tough times as well. And palm is one of the big export commodities. In fact, they would try to maximize the exports and help the economy rather than curtailing supplies.
Sure, Sanjeev. And last question, if I may, which is a small one, but you have already spoken about Horlicks, Sanjeev. Horlicks is a powerful brand, but any plans to make it a platform or an umbrella brand and get into newer categories? Because you only spoke about HFT, but if you take a 3-5 year view, do you think Horlicks extending into newer segments?
Yeah, we are working on a huge number of innovations, and our first objective is to do the integration, set the fundamentals of the brand right, get the growth going in the core of the HFTs, and then we would be looking at adjacencies. But you're right, this category, this brand, and the technology behind it is giving us huge room to look at it in many different ways. So I would say watch the space, Vivek.
Got it. On that note, thank you and wish you all the very best.
Thank you, Vivek.
Thank you, Vivek.
Thank you. The next question is from the line of Vishal Punmiya from Nirmal Bang. Please go ahead.
Yeah, thank you for the opportunity. My question is on the volume growth. Similar to the domestic consumer sales, where you have mentioned the 2-year CAGR, excluding the acquisitions. If you can also help with the UVG on a 2-year CAGR basis, and also for the same number for the previous quarter to basically understand the trend of UVG on a 2-year CAGR basis, excluding the acquisitions.
Yeah, Vivek. Vishal, sorry. Vishal, Ritesh would give a more nuanced answer. But in principle, if I may tell you, that if you look at it whether from a market lens or whether you look at from our own company lens, the categories which are most impacted on volumes are those which have raw material input prices going up much more. So these would be categories like fabric cleaning. This would be categories like skin cleansing. And if you look at a 2-year period, tea, where the prices have gone up significantly. These are where the volume, for reasons that we have explained, have been impacted, whether it's the market or whether it is our business. Yeah, Ritesh, anything else you would like to add?
No, Sanjeev, you captured it pretty well.
So would the trend be similar for 2Q and 3Q in terms of a 2-year CAGR number? Or would it be declining or slightly higher in nature?
Ritesh, any perspective on this, please?
See what has happened, one of the things which we called out earlier, that the composition of growth, typically in the past, HUL would have a composition where 2/3 growth would come from volume and 1/3 would come from price. That equation has evolved with significant inflation that we have seen. And we're talking some serious levels of inflation. One of the charts we talked about, that the total material cost against the baseline of financial year 20 is 30% increase. This is for all materials put together at total HUL level. A 30% inflation is a scale that we have not experienced in the past. So what has happened in last few quarters, that the equation has changed where the growth is more price-led and volume, as you've seen, as we have reported. Last quarter, we talked about UVG of 4%. Current quarter, we talked about UVG of 2%. That has got impacted. So the balance has been more towards price compared to volume. But which is also the case with the market, as we saw in the market chart, where volumes in the market have taken more impact. Plus, do remember what we called out earlier, the impact of the price point packs, where we take price increases on a 1 rupee, 2 rupee, 10 rupee by reducing grammages, that impacts our volume. So we called out in this quarter, for example, circa 2% was the impact of volume impact because of the price that you've done using grammages in that part of the portfolio. So that should give you a little flavor between how the evolution is happening between price and between volume. But any specific, my suggestion is, can you just pick it up with Ravi and Saurabh later offline?
Sure. Thank you for the answer. Thank you. That's all from my side.
Yeah, and I'm just conscious of the time where we are with 15 minutes. Can we pick up 2 more questions, and then we pick up some questions online as well, please?
Thank you. The next question is from the line of Percy Panthaki from IIFL. Please go ahead.
Hi team, my question is on the demand front. While the volume growth and the demand scenario has remained lackluster in Q3, I think at least the Nielsen data suggests that within Q3, sort of December has been sort of a decelerating trend. So just wanted to understand if you think we've seen the bottom as far as demand is concerned, or sort of Q4 can see even further pressure compared to what we saw in Q3.
Thanks, Percy. Percy, in fact, the December numbers of market growth are not very different from the last 3 months of Nielsen reading.
Okay, I see. My mistake then in that case. So basically, there is no reason to believe that there is a further deceleration in demand scenario versus what we've seen in Q3 going ahead.
Yeah, as the data shows.
Okay. Secondly, I just wanted to ask your take on this. Are you concerned about the loss of wallet share of FMCG in the overall consumer spend? Because what I see is non-FMCG companies' results as they are getting reported, be it more niche companies like, let's say, a Titan or a Jubilant, where the number of customers it serves are lesser. But even, let's say, something like paints, where it serves a huge number of customers, even at the low income level, etc. The top line growth reported by the non-FMCG segments seems pretty robust. And in that sense, it seems that FMCG overall is losing wallet share with the consumers. So is that a cause for concern? And in your view, what is the reason behind this phenomenon?
Yeah, I don't think so. Yeah, these are very different consumer occasions, very different consumer choices. And in many of these cases, there would also be the pent-up demand phenomena. Yeah, there would be a period during the COVID period where people would have spent less. They would have the house painting, and now they would have been doing the painting, but the clash would not be there. I don't think this is a concern. I don't think from a mid to long-term basis there should be any concern about the robustness of the market of FMCG in the country.
Okay, because I look at all these companies and obviously I'm adjusting for the pent-up demand angle, and I still see that the demand there is much stronger compared to FMCG. So while within FMCG you're doing well, you're gaining market share, the overall FMCG industry itself not doing as well compared to other areas of consumption spend was a little bit of a concern I had.
Percy, if you really look at it, even during the worst period of COVID, FMCG still grew, right? There was a quarter or so where, because of supply chain constraints, the demand did not disappear. Yeah, discretionary took a hit because people were not going out, or there will be items which would be impacted because the school children are not stepping out. Those would be there. But fundamentally, I don't think there has been any reshaping of FMCG from mid to long-term basis. Even now, the value is still there. Yeah, even when you look at 6-7% value growth happening in the markets, it is still there even during this tough situation. So we should not get clouded by volume, because volume gets titrated when the costs go up, when the prices go up significantly.
Right. And just one hygiene question in terms of methodology. When AC Nielsen gives out market share and calculates market share, does it consider digital or e-commerce sales in the market share calculation?
Ritesh, now they have started picking up, right?
Yes, that's right.
They have started picking up. Not every D2C they can capture.
Yeah, so of course the pickup is there across channels now. It is still thin outside GT, but the pickups have started improving with trade gaining more scale in other channels.
Right. Okay, that's all from me. Thanks and all the best.
Thanks,
Thank you. The next question is from the line of Latika Chopra from JP Morgan. Please go ahead.
Yeah, hi. Thank you for the opportunity, and thanks for all the insights.
I said hi.
Hi, Sanjeev. Hi, Ritesh. I just had two, quick clarifications on comments that you made earlier. One was this 2% impact on volume in the quarter. What was a similar kind of impact in Q2, or was this 2% an incremental impact on volume sequentially?
Yeah, if I just pick that one up, Latika. So yes, you're right. We called out that in current quarter, we had 2% impact of the price point pack. It was in a very similar range, little lesser, but in a similar range in the previous quarter as well, September quarter.
All right. And second question is for you, Sanjeev. I heard your comments on the B2C space. But as a leader in this beauty and personal care category, just want to hear your thoughts. Do you think, evaluating, introducing, India-specific brands, new brands with differentiated positioning could help cater to the niche segments better, versus introducing variants under your very well-known established brands or, bringing some of the global brands here? Yeah. And also in this regard, would you want to participate here incrementally, only organically via your premium business unit that you talked about, or would you be open to consider an M&A route a little more actively here as well?
Yeah, certainly. Let me answer it in many ways. First is, when we hear a lot of column inch being given to disruptors, we often forget the power of the big brands. Yeah, so one should never forget that the incumbent's power through big brands is a very powerful force. The second important bit is you are absolutely right. When we look at the premium business unit, it's not just the existing brands. Yeah, we have brought in Love Beauty and Planet. We have brought in Simple, and those are doing exceedingly well. And you're absolutely right also that there are Indian brands which have a great space to be extended. And one of the brands we are looking at very clearly is Indulekha, for instance. So watch the space, what happens on Indulekha going forward. And you have seen over the years, we are never averse to M&A. And we always look at M&A from a lens of strategy, the value that we can create, and the timing at which we would like to get in. Just when we would not also like to go in and acquire a proposition which has not been proven in, and it has just got sales by throwing in a lot of money behind consumer action. And if there is not a distinctive property, then we also know it will not sustain in the long run. So we are very circumspect, but we are looking at all options, and we are very clear we are the market leader in personal care, and we are not going to give up this space.
Sure. Thank you so much, Sanjeev and Ritesh, for your answers.
Thanks, Radhika.
Thank you. The next question is from the line of Jay Kumar Doshi from Kotak. Please go ahead.
Hi, thanks for the opportunity. My question just got answered, so I have just one request. Would it be possible for you to share some data points starting FY23 that allows us to assess your progress on, in the B2C space or progress of premium beauty sort of business unit? Some data point, maybe market share, maybe growth, or the scale as a percentage of revenues, maybe starting FY23.
I leave it to Ritesh. Ritesh, your thoughts on this?
Yeah, so what we have done is, Jay Kumar, as you saw that as we had activities, innovation, we started covering the digital space and digital first brands in our conversations, and we will continue to do that as more action keeps happening in that space. So you will get from us regular updates on our business progress of digital first brands, and for that matter, the way we are evolving our digital sales through multiple channels of EB2B, EB2C. So even the progress that we have done on digital sales, you will keep getting updates from us.
All right. Thank you so much.
Thank you.
Thank you. The next question is from the line of Mihir Shah from Nomura. Please go ahead.
Yeah, hi. Thank you, team, and thank you for the opportunity. So just wanted to understand ad spends a bit better. While they have seen moderation this quarter on an absolute and a percentage of sales, the share of voice has been maintained versus share of market. Now, would this be because the market spends have moderated? And if so, would higher sales from digital be a key reason? As we understand, sales from digital may not require similar quantum of ad spends versus other channels.
Ritesh, do you want to take this?
Yes. So, what we do for our advertising and sales promotion, there are 2 or 3 parameters which determines the amount of investment we'll do in a quarter. A, of course, the amount of innovations and activations we have. That determines the lead as to how much we want to invest in a quarter. B, second important element is the competitiveness. Ultimately, what we do, as you saw also in the chart that we spoke about, that our share of voice, which means the amount of money we spend in relation to the industry, has been more than our share of market. We have maintained that in this quarter as well. Now, of course, what has happened, given very high amount of cost inflation and cost versus price equation across FMCG industry, we have seen different levels of A&P investment across categories. But our very clear strategy has been to ensure that we maintain healthy investments across our brands and keep driving market development across the portfolio. So we have not pulled back on any of those. The absolute amount of money then gets, of course, determined by the total amount of investment that happens in the category and in the industry. With very clear call out, as I mentioned, that our share of voice has remained above our share of market.
Understood. Okay. I will have another follow-up on this, but I'll take it offline. Second question I wanted to check with you, Ritesh, was, the detergents or that has seen higher single-digit volume growth this time after quite some time, quite a few quarters. I believe it was flat all along the entire last year. Safe to assume this is because of improving mobility, and would it be a reasonable assumption that other impacted categories which were impacted by mobility can see a similar pickup in trend?
Oh, absolutely, Mihir. You would have seen Ritesh gives a cut by, more discretionary items and the health, nutrition and hygiene portfolio. And clearly, the more discretionary items, as the mobility improved, the sales went up.
Thank you. No, that was very clear. That's all from my side. Thank you so much.
Thank you.
Thank you.
Thank you. The next question is from the line of Kunal Vora from BNP Paribas. Please go ahead.
Yeah, thanks for the opportunity. Just two quick questions. First is, if you can help us understand the financial impact of PLI scheme, what should we expect over 5-6 years? What will be the investment needed from your side, and what are the benefits you are expecting? Second, I also wanted to check on coffee. International prices have really shot up, while in India we not really see any major increase in prices from especially in the consumer end. And also, if I look at your sales, it's only about high single digits. So can you help us understand how the procurement works? What is the cost inflation which you are seeing, and whether you passed on the same? That's it. Thank you.
Ritesh, can you take it, please?
Yeah. Let me pick the first question. So on PLI, there are two clear conditions, Kunal. A is investment condition, and B is the growth that we bring in these categories. And over the next 6 years, the way we are able to invest in these categories and the kind of growth we will end up garnering will determine the absolute amount of incentive we'll end up getting. But let me still help you with a ballpark number. It will be 300 to 500 crores over the next 6 years, including, as you know, from current financial year, the scheme starts. So it will be 300 to 500 crore range. Let me also call out in the same breath that our intention is to use these resources to invest in these categories, to drive market development and to drive capabilities, so that we're able to move with quick pace growth in these categories.
Okay. So just to follow up on that, will this come uniformly or it will be back-ended?
No, as I mentioned, it will be linked. Of course, first of all, for this financial year, as we speak, we are already in third quarter of the financial year. The way it will get panned out will be the rhythm of investment and the rhythm of growth. So I would not be able to give a phasing year-wise, but suffice to say it will be in the ballpark of 300 to 500. What we also going to do is we're going to report this in other operating income. That's the line in which this savings, this incentive will get reported. But we will bring to speed as we keep reporting our information year on year. We will give more amount of insight into numbers.
Sure, that's helpful. On coffee? Yeah, my second question was on coffee prices.
Yeah, so can you just repeat the second question? I had a little bit of stack.
Yeah, sure. So the question was that international coffee prices have moved up sharply. I think multi-year high or maybe highest in the decade. While in India, we have not really seen any major increase in MRPs of coffee. And also your own growth is in high single digits, which implies that there is not really much of a element of pricing or volume growth there. So if you can help us understand how your procurement works, what kind of cost inflation you have seen in coffee, and whether you have passed on the same to the consumer.
Yes, on coffee, we are seeing inflation in commodity in India as well, and but not of a scale which we had seen anywhere near to what kind of inflation up and down which has happened to tea. So it's in a smaller, narrow range compared to what we've seen in other commodities. So I would not say something very substantial for us to talk about, but it'll be important for us to see in quarters ahead how that pans out. But I would not say it's something substantial for us to call out.
But is there a complete disconnect between Indian price and the international price? Because international price have moved up sharply.
No, it is not the case. Sometimes there's a lag between how different geographies react. But commodities, the way we have seen, coffee also is a global commodity, it will catch up to international price trends. There might be a lag, a quarter or so, but won't be more than that in my mind.
Understood. That's it from my side. Thank you, sir.
Kunal, just to your question, if we look at the tea industry, it's not tea, for instance. It does not always move in tandem with the prices in Kenya or Sri Lanka or global prices.
Mm-hmm.
Yeah, because these are many times tea, for instance, we are one of the largest producers, but we are also the largest consumer. So if it is not much of interaction when you don't import large amounts of coffee, or exports them, then at many times it does not move at the same wavelength.
Understood. Thanks, Sanjeev. That's helpful.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. A. Ravishankar for closing comments.
Thank you, Faizan. With that, we will now come to the end of the Q&A session. If there are still unanswered questions, please feel free to reach out to any of us at the IR team here, and we'll be happy to answer them. Before I end, let me also remind you that the playback of this event will be available on the Investor Relations website in a short while from now, and you can go back and refer to it. A copy of the results and the presentation, if not already with you, is on the website, and you can go back and refer to that as well. With that, we would like to draw this call to a close. Thank you everyone for your participation, and have a great evening ahead. Stay safe, stay well. Thank you.
Thank you. Ladies and gentlemen, on behalf of Hindustan Unilever Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.